And he might have gone in, but I think he might have had to go in transit. All right, well, Sean, thanks for joining us. We'll start right in. Hopefully this, and that was the wrong thing to hit, so let's see if I can find the right thing. Right. Let's go to settings. Everything was working pretty good until now. Here we go. Okay, now we're all set. All right. What we're going to do is go through a couple problems, and I'll take some questions. They want to know what is the consolidated balance sheet for equipment as of December 31/14. So they're looking for just a particular account, and we're going to need to visualize what it looks like on the worksheet. That's how I approach these problems in order to figure out how to do it. But now we know at least we know what's wanted. And we take note of the date, 2014, and now we read the problem. So here we go. Power Corporation bought 100% Kimmel on January 1, 2012. So right away we know we're dealing with more than 1 year. In fact, we're dealing with, we can count it up, we're dealing with 2012, that's 1 year, 13, and then the end of 14, so there's 3 years under consideration. So I'll make note of that. This is a lousy 3, but it'll work for now. Then they tell us Par's equipment has a book value of $420,000, but a fair value of $520,000. That's very interesting. And if you think about that for a minute or two, you might come away by saying something like, you might say something or you might do a physical act. And with your finger, but not what you think. Sean, you got any idea what I'm referring to? What is this information? How is this information relevant to the problem? Okay, well, who bought who? All right, so we're really concerned about book value and fair value. That's right. That's right. And which particular company we're going to be looking towards in this? That's right. So is this information about Par's equipment mean anything to us? That's right. So the finger I was referring to is scratching your head, saying, why do I need to know this? And this is what the CPA exam does best. They put in information that we used to call it smoke screen. It has nothing to do with the problem, and we just don't need it. So we skip through that, but it's there to confuse the already confused. So we're not confused, so we just skip through that and say, that's nice, but who cares? Kimmel has equipment 10-year remaining life. Now we get to the root of what we do need to know. We find it has a book value of $272, but a fair value of $420. So that means that as of the date of purchase, which is what we're talking about right now, as of the date of purchase, we have a situation where we know that the differential is 400 minus 272, or I think that's 128. There used to be a way to type, but I'm not finding the type mechanism right now. So it's 128,000. I know the 8 is going to be problematical for me, so let's see if I can do it. All right, not too bad. 128K, 10 years, and over 10 years, the depreciation of $128,000 per year, doing the math on the calculator, is $12,800 every year. So there we go. Now we know that $12,800 is the depreciation taken each and every year. And we started January 1, 2012, and we got 3 years to go. So we can just do the math. 3 times the 12,8. In fact, the way to do it would be to do like this. 3 times, put a little decimal point there. The 3 times 12,8. And we're going to get a number. And that number would be, I'm just doing it on my calculator. And you should do it in your calculator because I'm not going to be able to write everything out here. 12,800 times 3 is 38,400. That's what I come up. Should have been the amount of depreciation taken on a consolidated basis each and every year. All right, that was a mistake, so there must be a way to erase that. Here we go. I think this is it. Okay, I'm learning on the job here. Here we go. Okay. All right, so that's cool. Now we've got a situation where we need to know, okay, what's next? So what's next is, let's see what other information they give us. On December 31, 2014, Paul has equipment with a book value of $294, but a fair value of $442,200. Again, there seems to be some information that we don't need. We will need one part of this, and that is the book value on PAR's books at the date of 2014, December 31st. We do need that, and that's now it's given to us. It's 294. So what you might want to do, if you're following at home, is write down on your paper, 294 is in the column for PAR what its book value is for equipment, because we're going to do consolidated, so we need to put together PAR plus Kimmel. We don't need to know the fair value. We don't care about the fair value on PAR's equipment. And the next thing we need to know is what would have been in Kimmel's column, its balance sheet for book value at 12/31/2014, and they give you that at the number of 190,400. Now they tell you a fair value at that time, but that's not relevant. We don't need to know that because the fair value has changed, but we're only interested in adjusting for the fair value at the time of the acquisition. We're not interested in what the new fair value is at December 31st, 2014, because that's all conjecture. We know for sure that we could do the number of the 400 at the date of acquisition because that's what we purchased it for. That's for sure the fair value, but this 357 is irrelevant. We can't rely on that and adjust our books for that number. But we do need to know the book value, and that is, if you would visualize, let me see if I can do it here 1 second. If you visualize how you have been doing the consolidated, you would have had 2 columns. One column would have been book values for PAR, which is the parent. And then you would have had a column for the book value of Kimmel. Let's see, what is this? All right, hopefully the recording is still working. I'll find out in a minute. And so you would have looked to these 2 columns for the book values so that you can then make your elimination entries, which I'll say here. And those elimination entries would have been for the date of acquisition value adjustment based on the date of acquisition differential between the book and the fair market value. And that was the 128 over here minus the 272 as adjusted for the depreciation over 3 years, because this is at the end of the year. So at the end of the year, there would have been 3 years depreciation, 2012, 2013, and 2014. So now we can compute the number. We did compute the number for the equipment, that the depreciation for 3 years is $38,400. So write down in your paper. Let me just check one thing, Sean, while I'm thinking about it before I make sure that the microphone still seems to be working, so I think we're okay. Yeah, okay, that's good. Now we'll go back to a large screen here. And so we know that depreciation is $38,400. That depreciation is going to be a credit to the equipment for Kimmel. And if you again, you have to visualize the way the columns would work on the worksheet. It would have PAR's book value, Kimmel's book value, and then you'd have the elimination entry. You would be doing two things with that elimination entry for Kimmel, in this case, in the elimination E entry. You'd be booking the differential between the 128 found at purchase minus the 3 years of depreciation. And the differential is, first you'd be doing the book up of the 128. So you could write on your paper 128, because that's the amount above the book value when we bought it that we booked up. That was, again, Chapter 2. That one, date of acquisition, we always book up based on the fair value over the book value of the subsidiary that we're buying, and here it's 100%. So that would be 128, but then we have to subtract 38,400 for the 3 years of depreciation. So the net of those two numbers is 89.6. 89.6. I think we're on to something here. I didn't check the math on this so far, but let me go ahead and check it. Make sure we're doing all right. All right, so 89.6. And then we'll get to the bottom line in 1 second. We're ready to go. All right, so 89.6 would have been in this column, the E column. Why did I get that? That's the, again, 128 was the initial value difference between the book value and the fair value. Then we had 3 years of depreciating it, which was a total of 38,400. So 89.6 would have been added to the equipment in this column, and now all we have to do, that's the net. That's the net addition to equipment, because it's net of depreciation, would have been added in the elimination column. Now all we have to do is add to the book value in Kimmel and the book value in PAR. So take 89.6, add in the book value on equipment for PAR, which is 290,400. That's there. Add it to the book value on Kimmel's books, 190,400, and you're going to get the answer, which will be answer A. 574,000. And what you've done for this particular type of CPA exam question, which is multiple choice, is you're answering just one facet of the worksheet. The way I worked it, may be the long way to work it. I won't take that away. But the way I worked it is I envisioned how it would look on the worksheet. What would we know? We would know the parent's book value, we would know Kimball's book value, and then we'd have the elimination column where we would first add the couple ways of doing it. First, we could add the differential that existed at the date of purchase, that 128, and then subtract the 3 years of depreciation, which is what I did. The other way you could have done it is the way it actually would have looked on the worksheet in the third year, is first add in the differential as of 1/1/14, which would have been 128 minus 2 years of depreciation, and then take the third year's depreciation. It comes out all the same. Okay, any questions on that? I haven't been able to check who's listening, but let's see if I can check that now. Close presentation. I'm afraid to do it, but I'll do it. That wasn't too cool. Let's go back here. Okay, Sean, do you have any questions? Okay. Oh yeah. Oh yeah. That's right. If they had bought it in 2014, then a whole different numbers, whole different ballgame. All right, so let's go to the next problem, which is really one problem but two slides, and they are. It's going to be going to a worksheet. That's the idea. So first problem, the first part is to read what the issues are, what the facts are, and hopefully you can see it large enough on the screen just to get the facts. And the facts are the following. Again, the first thing to do is always to sort of see where we're going with this. And this particular problem asks you a bunch of things, but we're just going to say, let's go do a worksheet. And so what we're going to do is have a worksheet presented to us to fill in. So let's see what we got. First, we might want to see what year of the worksheet we're doing, and that's December 31, 2000 X9, so that when we see when the purchase occurred, we know how many years we're dealing with. And we do. We see that we're dealing with 2 years because it was bought in 2008. Sort of similar number, but not by design. Here's another 128,000 number. This is that's what the purchase price was for. Purchase price for 100%, $128,000. Okay, so now we know what the purchase price was. We'll keep that in mind, and we'll go forward to get more facts. More facts was that as of the purchase date, the buildings and equipment was $20,000 more than the book value. That's in that second sentence. So we know we're going to need that information. And then when the next sentence tells us more information we need is that it's going to be depreciated on a 10-year basis. So that means that we're looking at $2,000 per year of depreciation, and that's relevant. Let's see. Thought I could type that in, but it's not working. At any rate, we have $2,000 of depreciation each and every year. There we go. We should be able to write now 2,000. Nope, it's not working there. It only works on that side. Okay. All right, so $2,000 per year of depreciation. We'll just write it down here. 2K. The best way to do this, if you're doing it on your own, is just set up like a little amortization schedule so you have it and you could figure out what the book value would be, what the book value adjustment would be any given year during the 10-year process. Then they say new information. Again, this is a simulated problem from the CPA exam, although goodwill is not amortized. So there must have been goodwill on the date of the purchase. Mills management concluded at December 31, 2008. Of course, we're not doing 2008, but they concluded that goodwill involved in its acquisition of roller shares had been impaired and the correct carrying value was $2,500. Well, this is a confusing problem if you were to try to work through it yourself, which I encourage you to do maybe 2 days or 3 days from now, before Monday, obviously. And the reason it's confusing is you first might want to ask yourself, well, how do I handle this? What does this mean? Well, you have to just take it at face value, which means the goodwill is now on the books for the consolidation at $2,500. There was some number determined at the date of the purchase that goodwill was. Whatever that was, that's been impaired and written down to $2,500. So going into 2009, and there was no additional impairment in the 2009, that's the last sentence, they tell you that. In 2009, the correct carrying value for goodwill is $2,500. So it just tells us that when we do our consolidated statement in our elimination column, we're going to add $2,500 for goodwill that belongs to the parent in their purchase of roller shares. That's all it tells us. That's all we need to know. Do we need to know what the original goodwill was? We're just trying to do 2009. We don't need to know it. Do we need to know what the impairment loss was? No. Could we figure it out? Well, maybe, but I'm not interested in it, so I'm not even going there. So now we have the two facts that seem to be relevant to our worksheet, and we'll get to it in 1 second. Let's just go over the two facts. First of all, we could do the following. We could say that at the end of 2009, the balance, the additional balance to the equipment based on the original purchase would be 20,000 minus 2 years of depreciation, or 16,000. So our net addition to equipment, because the equipment was more than the book value. If it was less, it goes the other way. Just keep that in mind. If it was less, it goes the other way. And so in this case, our net addition to the equipment is $16,000. That we know when we get to 2009. What else do we know? We know that the goodwill should be 2,500. So those are two entries that we're going to sort of need to see get into the worksheets when we're doing it for the 2009 consolidation. And that seems to be the only real facts that the problem gives us that we need to know. Of course, we need to see the balance sheets and the trial balance itself for 2009 in order to do the worksheet, and that's next. Any questions so far? All right, so let's go forward. Now, I know this is small, and the worst part of it is I had corrections done to the worksheet that are relevant to the way our text does it, because this comes from this Wiley simulated CPA. So this worksheet's done differently than the way we do our worksheet, so I'm going to have to make the corrections going along. And I'll do that as by sort of whiting it out or blacking it out. So let's go through what our entries would be before we even take too much of a look at the actual worksheet. We know our entry, we can start with the S entry. Our S entry would be to debit the beginning retained earnings of the subsidiary roller company. And in essence, that's what's there. That's makes it too hard to see, so let's get rid of that. And I want to try to check it so you can follow along. So I'll do it here. There you go. That 48,000 is the way our S entry would work. 48,000 as a debit. The next thing we would be debiting is the common stock. There's another, there it is right there, 60,000. So let's stop there, and I'd like what you should do is follow along with me on a piece of paper, the S entry, because it'll change a little bit from what we see on the worksheet, but we can follow along better if we actually do this at home. So the S entry would be debit retained earnings for 48K, debit common stock for 60, and these are things we know, and that total is 108. And that total, anybody know where the credit goes? On the screen? Yeah, there it is. Yeah, there's a little bit of a live chat line over it, but the investment enroller account is here. Do you see where my pencil is? Okay, so that's your investment account. Now, don't pay attention to what they have here. Let's do on a piece of paper our investment account, our T account of investment account, just for purposes of the consolidation. So this is not a T account on any books. This is the T account of the worksheet. So I'm going to write down a T account called investment enroller. It starts off with a balance of 142.5, and I just credit it for 108 because you had the right idea. The S credit, the entry of the S entry, the credit goes to the investment account. So now I got a credit of 108 there. Let's do I think it's the I entry, which is the income from the subsidiary. So if we were to do that, and again, you just got to bear with me that the way this problem works is it's a little different because it's Wiley. The net that we want to do is we want to take the income from the subsidiary roller and we want to zero that out. So that's a credit, 34,000. So we're going to want to debit 34,000. And indeed, they really do have that. If you look at here and here, although they break it down into two pieces, it's really a debit of 34,000. And in our I entry, the credit for that 34,000 goes to That's right. That's right. It goes there. So let's put that there. 34,000. It goes to the investment account. So far so good. Okay. All right. So now I have 2 credits in my investment account on my worksheet paper or my scrap paper of the T account. Got 108 and I got 34. Now the next entry would be the A entry. So let's do the A entry. The A entry tries to put the assets in order based on what we learned from the problem. Now one of the things we learned from the problem was that equipment was overvalued by 20,000, or it was over the book value by 20,000, and yet it gets depreciated by 2,000 each year. Since this is the beginning of the second year, it means that at the end of the first year, we started with 20. So you want to write this down. We started at the first year, we started at 20, and we depreciated 2,000 in the first year. So it means at the end of the first year, our differential between fair value and book value was a net of 18. Again, we started at 20. We can go back to the problem and take a look later. The equipment was over the fair value was over the book value by 20, but it was going to have a 10-year life. So at the end of the first year, we had adjusted it for 20, but had 1 year of depreciation because the purchase was at the beginning of the year, so we had 1 full year of depreciation. So at the end of the first year, the net differential was 18. So that means at the beginning of 2009, the second year, our differential 18 needs to be adjusted in the equipment account. So I guess the best thing is don't pay attention to the way you see the numbers here. Just follow along on your worksheet that I'm working at home. In my desk, you should work it at your desk. And that is that an A entry would look like the following. We would debit the equipment for 18,000 and credit what account? Investment. That's right. That's right. So now we can add another credit to our investment account, 18,000. Now, of course, someone astute watching this might say, well, wait a minute, that's not the full A entry. And they're right, because we need one. We did say when we read the problem, we said there's 2 assets that we're going to need to adjust in our elimination entry when we get to the worksheet. One was the equipment, and the other one was, if you remember, it was goodwill. The problem told us goodwill would be having a carrying value for the consolidation at 2,500. So a second, if we were to break this entry from compound entry to two different entries for the A entry, the second A entry would be a debit to goodwill, 2,500, and a credit to, that's right. So now our investment in Roller Co. T account for the consolidation has 108 credit, 34 credit, 34,000 that is, 18,000 credit, and 2,500 credit. That's what we've got so far. It started at 142.5, and we're rolling along as there is the goodwill amount, the 2,500. Okay, before we go too much further, let's do the other entry, which is the D entry. D stands for dividends, and let's see how that works out. So we find that Roller had $20,000 of dividends over here, and the D entry tells us to do what? Well, this is what kind of balance is this? Well, it looks like it. That's why part of this course, a challenge to this course, I should say, a challenge to this course is to be able to read these single column trial balances. This dividend really represents a debit. And the dividend for the subsidiary needs to be zeroed out. So if this is a debit, it means we're going to have to credit the dividend, and that's what they've done over here. Okay? So the D entry is we're debiting we're crediting the dividend, and our debit is to what account? That's right, the investment. So now I'll put down on your little scrap paper under the investment roller account, T account, 20,000 is a debit, and we're rolling right along. Now let's do the, I think it's the, I'm not sure I have the right letters here actually. So if I'm doing the wrong letters, somebody can just accuse me of wrong letters. I think I got the right idea. Let's do the entry for depreciation, which I forget what letter it is. I want to say E, but that doesn't sound right. So the depreciation for the year is going to be 2,000 for the equipment, because that's what we know it to be. And so that entry has to be, since the value is over the book value, so this depreciation is a addition to depreciation, as opposed to if the value was less than the book value, it would be a credit to depreciation. In this case, it's a debit to depreciation of $2,000. And the credit is to, I think so, yeah. So let's put that down in our column as, and let's see where we are. I put that in our investment roller code T account. Now let's see where we are. I want to take a balance to see. Go ahead. That's correct. That's correct. We did not, yeah. Let's see now. 34. Okay, so I think I'm still out of balance from the, let me see what I'm at. My T account looks like I'm out of balance by 2,500, which sounds like the goodwill. And I'm going to see why in a minute. Let's see, hold on. 45 plus 20 minus 2,500. Oh, I know why. We did the depreciation incorrectly. We had the right number up here, but the credit doesn't go against the investment account. The credit goes against where? Or the accumulated depreciation. If the equipment account, if the equipment account was net of depreciation, that'd be absolutely correct. The credit really goes here. Again, don't pay attention to this worksheet's numbers. What you should do is just fill in the numbers the way we do it in our entries, and it'll come out fine. So now what we do is we take away from our investment roller account. We don't put that 2,000 depreciation adjustment into the investment roller company. That goes against accumulated depreciation. That's how that entry works. And now if you take that 2,000 credit out, if you do the balancing of the T account, you started at 142.5, you added as a debit the dividends of 20 in that entry, then you subtracted 108 from the S entry, you subtract as a credit 34,000 from the income entry, you subtract 18,000 as part of the A entry, and 2,500, which is the goodwill, as part of the A entry, and you'll wind up with a 0 in the investment and roller, and now you're okay. And you know you're okay. And that's pretty much how the worksheet should work from the standpoint of the actual adjusting entries in the elimination column. What I will try to do after this is I'll try to actually see if I can correct the approach that Wiley takes here to this worksheet to correspond to the way we do it. That would be something that would be good for all the students to do, so that you can stay consistent with our text. All right, any questions on that? Notice that after all things are done, no matter how you do it, the net income in the consolidated column is 84,000, which corresponds to the 84,000 of the net income in the parent, and that's because the parent used the equity method, which the problem told us. Notice that the dividends are just the dividends paid to the shareholders of Mill Corporation, not including the dividends paid from Roller to Mill. So it's just the 30 that went out to those shareholders. The retained earnings, the ending retained earnings is 185, same number here. So these are your checks after you do all the math up and down to make sure you've got the right numbers. The investment account, we already did it on our own. T account came out to 0, so that's fine. The goodwill comes to 2,500, which is what they told us it should be. So we didn't really know what happened in the past 100%, but we didn't need to know it because the problem just told us what the goodwill should be. The equipment adjustment, the net equipment adjustment, turns out to be exactly what we expect it to be. Where's the equipment here? It's a $20,000 debit the way they did it, and then they showed it as a $4,000 credit. Well, that's the same thing. Our net, but it came out the same way. What we did over here is we first did 18,000 here, and then we did 2,000 in this column. But it's the same thing. It's the net of 16 in the equipment. So that proves out fine. This particular 30,000 is an optional entry, which we didn't talk about, so I'm going to blacken that out. And truth be told, I couldn't even figure out how they came up with that number based on what the problem told us. But it's probably buried in the trial balance that they showed us in the problem that I didn't take a look at. And also, here we go. The ending retained earnings down here is the same as it is up here. That's where it's carried from. The common stock is just the common stock of the parent, 200,000. And things are starting to look pretty good, I think. How you get to the numbers over here using the ASIDE approach, according to our textbook, that would probably be a good thing for you to practice at home, and then check the recording to see how you worked out. I think that would be good practice. Okay, so let's see now. Where does that take us? That takes us back to seeing who's here. So Sean, it's just you and me. Okay. Do you have any questions on what we did? Right. What I would do is see if you can just block them all out. Do it according to the textbook ASIDE entries and see how you come out. If you're missing something, as you can see, when I made a mistake, I was out of balance in the T account investment roller. I was out of balance by the depreciation, and so I immediately said, okay, what did I do wrong? Oh, I see what I did wrong. I'm not supposed to credit the depreciation to the investment account. I'm supposed to credit it to the accumulated depreciation. It's this year's depreciation. So that I immediately could see my problem and fix it. So I think on a level, if I had planned to make that mistake, that was a pretty good mistake to make in front of what might be thousands of viewers to this recording. But but at least I was able to quickly catch it by seeing that it corresponds to a particular number and then realizing what my mistake was. Certainly, even if I was doing my own quiz and grading myself, and I didn't have enough time to fix the mistake, certainly one thing's for sure, I would have been getting most of the points of the worksheet by the time I got into that stage. So that's the good news. All right, so here's what we'll do. Unless you have any other questions or points, I'm going to stop the recording, and hopefully it'll work, and I'll send it after the class to view. And anybody can send me questions vis-a-vis email. I think I announced and if I didn't, I'll make the announcement now official. But you can't bring the textbook and you can't bring a computer, but you can bring any amount of handwritten notes you want for Monday. So I guess that means if you want to write out the whole chapter, you could do that, but they have to be handwritten. All right, so Sean, thanks for participating today. Appreciate it, and I'll see you next week. Okay, take care.